Hello, this is Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 168th episode. This is our year-ender. Today, we're welcoming back Dr. Komal Sri-Kumar, President of Sri-Kumar Global Strategies, based in Santa Monica, California. Sri is a senior fellow at the Milken Institute and previously spent over 2 decades with the Trust Company of the West, or TCW. It is now a tradition of Kopi Time that I review the year with Sri and then look forward to the next year. But before I bring Sri into the conversation, I'm going to read a few sentences from the transcript of our podcast from last year. I think it's really, really good context. First, on cryptos, Sri says, I'm very old-fashioned, so I would like to explain my bias with respect to crypto. Even when the Federal Reserve policy is something that I do not like, I still think money should be created by a central authority. I need to be able to touch it. I need to be able to feel it. And so I'm not a believer in crypto, and I'm not going to talk in terms of what it might do. Yes, they can get a jump up due to Trump policies, but I'll be really watching to see how far the run-up goes. Good one, right? Number 2, on gold. I'm a big fan. And the reason is that currencies are being debased right now. All paper currencies are losing value because everybody is misusing the currency issuance ability. So I think gold has a significant upward move still. Mind you, December 2024, this discussion. And finally, on number 3, on Fed balance sheet. You would think that they should take it back to pre-COVID level of 4 trillion, if not the Lehman Brothers level of 800 billion. But no chance. It's not going to go anywhere there. I think you'll be lucky if it goes to US dollar 6.5 trillion. Sri, a warm welcome back to Kopi Time. What's the Fed balance sheet level today?
It's somewhere in the range of about 6.7 trillion today. And it is in the process of going up because they have just instituted quantitative easing again.
There you go. So I think we're not going to be lucky to see it go to 6.5 or below that. So Sri, it was a delight to have you last December. I'm so grateful that you have made the time to do it again with us this year. So let's begin with you assessing 2025. What surprised you on the upside and what surprised you on the downside in the economy and markets?
What surprised me on the upside, Timur, was the fact that the economy continued to remain very strong despite the tariffs. And that is, in a sense, not totally surprising. Tariff impact happens to be spread over time. So I think it is more a 2026 event rather than 2025 event. But you asked me for what surprised me. On the upside, that is what was surprising. What was not surprising was the downward impact of the policies, both the Trump policies as well as what the Federal Reserve has been doing. The fact that inflation has remained stubbornly above the Fed's target, and the fact that the dollar has weakened, and you referred to the fact that the gold has shot up. And as of this week, beginning of the week, we still have the gold trying to get to a new record. And silver has risen more than 100% over the last year. So I think you're going to see more of that happening, and that is not a surprise at all on that side.
Sri, in terms of U.S. fiscal position, I'm estimating a slight improvement in 2025 over 2024 for 2 reasons. One is, of course, the big jump in tariff revenue, and second is the big pickup in personal income tax returns thanks to the booming stock market. Expenditure side, hardly any correction, but those things are helping the deficit to come down a tad. So by my estimate, 6.8 last year, perhaps 6.5 this year. Do you see this as a positive development, and does it make you constructive for 2026 or not really?
Timur, once again, I would say it is a matter of timing. You referred to the fact that expenditures have not been cut back. It's only the revenues which have come in. If the U.S. Supreme Court disallows the tariffs, and it's a high likelihood that that would happen, then the Trump administration very reluctantly is preparing to give them back, give the tariff revenue back to the people, the U.S. companies which paid them. Costco, which is a giant retailer in the United States, has already sued the Trump administration wanting to get its part of the tariff revenue back. So when you go into 2026, I think the expenditure, as you said, is not cut back. It's not going to cut back, especially before the midterm elections in November of next year. On the other hand, revenues are going to be coming down if they have to give up some of the tax revenues. So the fiscal deficit, 6.8% of GDP to 6.5% of GDP. If anything, I would say the movement would be towards 7% of GDP for 2026.
Oh boy. Okay. I'll have to keep that in mind when we talk about the fixed income market outlook. Shri, what about the fact that while a lot of the discussion is about the big run up in US stock market, 2025 was also characterized by very strong run up in European stocks, Chinese stocks, even where I live in Singapore, we're having a banner year. So by and large, equity markets have done very well in 2025, even outside the US. Was that a surprise to you?
It was somewhat of a surprise, yes. I thought what was happening in the inflation side, what was happening with the fiscal deficit would be reflected in both the bond and equity markets. But equities have continued to rise, as you mentioned. And a big part of it, there are two reasons I would give to you. One is that the presence of artificial intelligence and people thinking that is going to be panacea, manna from heaven, and everything would be changed because of AI, that has given rise to a big chunk of the upward movement in equity prices. Second, the Federal Reserve has been very easygoing in its policy. And every time before the meeting, the markets are wondering whether the Fed is going to cut again. And when the expectation is that it will, the market goes up even further. So I would say the AI-related push-up has helped. And some of the Fed expecting to ease is the second factor. Now, some managers are saying you should be now moving away from the Magnificent Seven, the high-tech stocks, and go to the run-of-the-mill companies. That may yet happen, but the big issue so far has come from the technology side rather than from the entire stock market.
Right, Sri, just to share with you that in our part of the world, particularly around the Chinese tech pipeline, there's been a lot of exciting stories this year. Usually we hear these exciting stories when we talk about startups coming out from Silicon Valley. But now, whether it is the AI bandwagon or the biomedical area or manufacturing automation, lots of interesting market pleasing stories coming out of China, coming out of Southeast Asia. And that is also capturing investors' imagination to some extent. So I would have been really worried if the regional stock market run-up was entirely a beta to data centers and semiconductor manufacturing, because I think then that would be a highly correlated trade vis-a-vis the US. I have slightly more constructive look on or outlook on Asia, simply because I feel that there might be a broader story than just AI pushing up the stock markets. But fingers crossed on that. I think next year we'll have a proper stress test of that hypothesis. Shri, on the US Fed, this year, I have never in my life seen a chief executive of a nation take these sort of very, very politicized actions against an independent body, whether it is the repeated, threats to fire Trump or other Fed officials, investigations, and this entire big circus that we have going on who should be the next Fed chair. Actually, my surprise for the year, and I want to hear your view on this, is that the market has not reacted more adversely to all the developments we have had with respect to Fed independence this year. I know you have always been, sort of critical of the Fed, but I believe I'm correct in saying that you are also a firm believer in the sanctity of Fed independence. How is that the market not, reacting very poorly to what's been going on with respect to Fed independence?
Those are great questions, Timur. I would respond to you by saying, yes, you are correct in your evaluation of both my positions. I do believe that the Fed has made serious errors, but I also believe that they should remain independent and the president should not interfere with it. We have had presidents in the past who have interfered with the Fed, and quite actively. The best known examples are Lyndon Baines Johnson during his presidency. He was known, essentially, he was a very tall man, so he would go and essentially, supposedly, collar the Fed chairman by his jacket and tell him what it is that he wanted him to do next at the meeting.
Oh my.
Second one was Richard Nixon, who repeatedly bullied Fed Chairman Arthur Burns during the 1970s, which is what gave rise to the stagflation of the late 70s and early 1980s. The difference with the current situation is those two presidents did that behind closed doors. You never got to see them. Those two presidents did not call their Fed chairman all kinds of names, stupid, numbskull, various other things to be able to characterize them. This president does. So that is why it is very unusual that the president does it. Second part of your question, why isn't the stock market upset about it? Stock market is doing very well, thank you, because the president's badgering is for lower interest rates. The stock market also wants lower interest rates. So there is a meeting of the minds between the stock market and the president. The stock market investors don't care what nicknames he uses, what epithets he uses for the Fed chairman, as long as both of them are looking for lower interest rates. That is the story so far. My concern, and it is already starting to manifest itself, is that the stock market will stop being so sanguine if the long end of the treasury yield curve starts to rise. And over the last week, we have had almost a 10 basis point rise in the 2 to 10-year yield spread from about 57 to 68 basis points at the close of market on Monday. Why is that happening? It is happening because the markets are saying these kinds of pressures are going to increase inflationary expectations. They have cut interest rates 3 times in a row. The president has clearly indicated his next Fed chairman, whoever he or she may be, it looks like it'll be a man. So let's say whoever he may be, has to reduce interest rates. I have never seen a president come out and say that blatantly, I'm going to nominate a person to reduce interest rates. So when it is that apparent and the next Fed chairman actually complies with it, that's when I think the yield curve is going to increase very sharply. And that's what worries me about the market for 2026.
What about the fact that this huge amount of volatility around tariffs hasn't yet had a major impact on earnings? I think you said at the very beginning of this conversation, this is more of a 2026 story than 2025. But at that time, you were referring in the context of inflation. But is it the same also for corporate balance sheet, the impact of tariff? It's more of a 26 phenomenon?
It is also going to be more of a 26 phenomenon, and I'll tell you why. Initially, some companies have taken a hit on their profit margins. They have increased the tariff, but then they have gone and they have taken it on their balance sheet, their income statement, rather than pass it on to the consumer. That is partially done. When you go into 2026, it is going to be more of a tussle how you deal with it. Some companies have also got an exemption from the tariffs in some cases, and they have also benefited from it. Other companies are selling mostly to US consumers, and they don't have to worry about tariffs. So you have various reasons why it is not fully showing up in the corporate income statements. But I think it will become more apparent in 2026 when you cannot have those kinds of ways to protect yourself in a company.
Sri, the additional reason why we have seen corporate earnings holding up pretty well is because individual spending, retail spending has been pretty robust this year. And I am flummoxed by that because when I look at Michigan survey of consumer sentiment, it's very poor. But when I look at retail sales data, it's very good. How does one reconcile these two seemingly opposite data trends?
It's completely understandable to me, and I'll tell you why. If you think about the consumer as if he or she is one composite human being, then your point is very valid. But they are not. You have people who are at the low end of the income scale. There are people at the higher end of the income scale. The people at the higher end of the income scale are doing fantastic. Inflation doesn't bother them. The stock market has gone up way more than inflation has come out. So they are actually well off in real or inflation adjusted terms. And they are contributing to a big part of the spending. That is showing up in survey after survey. However, if you were low or a middle income worker, you find that in your case, inflation is more important because you can't afford to invest in the stock market. You are depending on interest income. That is not sufficient to offset the impact of inflation. And that is why you see lower income people complaining about it, whereas the higher income people do not. And that's why you still have retail sales continuing to do relatively well week after week in recent weeks.
Shri, that would suggest that there are adverse political implications for the sentiment data, which will not be mitigated by the strong retail sales data.
That is correct. That is true. And that is why you see that in President Trump's popularity ratings, it has come down to low level. The so-called MAGA movement, Make America Great Again movement, it is splitting up. There is more opposition within that movement. All of that is reflective of the fact that there are more poor, low income and middle income people in the country than there are high income people. And in a democracy, it's a total number that counts. And these people are going to decide what happens in November 2026. And so far, it does not look good for the president or the Republican Party. And if they lose the House in the November elections, it is going to be a big loss for them.
That's right. Now, to your point about cost of living being a major issue going into 2026, what's your sense of inflation, Shri? Energy prices are flat. Electricity, maybe you could tell us a little bit about where that's happening in the U.S. But overall, oil and gas seem to be fairly flat. Food prices seem to be flat. But still, we are seeing no meaningful trend toward inflation heading toward 2%. Do you see that trend persisting through 2026?
I do see the trend persisting because where the inflation is coming from services, it is not the goods that are contributing mainly, but services, car services, haircuts, employing people in the construction industry, housing industry. Those costs have gone up significantly and people feel it. And so you cannot live with goods alone. You have to pay for services as well. And they are taking a huge chunk of the upward movement in prices. If that were not the case, you wouldn't have consumer sentiment being so low. And also explaining that as far as the president is concerned, why it has brought down his popularity. That is also because people feel inflation and they are saying in survey after survey, that's what concerns them the most.
Why is service inflation high?
Service inflation is high because it does not have competition. In other words, this is what we call in economics as a non-tradable good as opposed to a tradable good. If you want to buy a good in the United States and there's a competition, if it is a car, you don't have to buy a US car, you can buy a foreign car. If you want clothing, you can buy US-made clothing, or you can find clothing which comes to the United States from China or elsewhere. However, if you want to get a haircut, those prices are going up. Construction workers, you cannot simply import them from abroad, especially now with restricted immigration under this administration. That is also contributing to a big increase in labor cost, and that is translating itself into price inflation. Average hourly earnings, we haven't had these numbers show up for a couple of months now because of the federal shutdown. But from what we can guess, they seem to be running at about 3.8% year on year. And that wage inflation is still too high to bring inflation down overall.
Okay, that's a perfect segue into your sense of the labor market. We're getting conflicting signals, Shri. So on one hand, the immigration tightness that you just talked about should lead to a tightening of blue-collar labor supply, and that should lead to higher wages, which technically is good news, but also lead to higher inflation, what you just flagged. But then there's this whole narrative around white collar jobs, that the AI disruption is going to create a lot of job losses there. It's not quite in the data, but anecdotally, we see here and there some tech company making some big, lofty announcements about how they don't need additional workers and so on. What do you make of all this?
I think there is clearly a loss of job opportunities due to AI. And what we are hearing is that it is affecting the younger population, people who are entering the labor force, who may be in the, let's say, early to mid 20s, and they are entering the labor force. They find very many of them cannot face the competition from artificial intelligence. And if you are looking for a position, for instance, as a legal assistant or information technology assistant, those kinds of jobs have been taken away from human beings they have gone to machines to do instead. So that area is, I think, affected. But what is going to happen is if the people adjust to it and develop skills which can be usable in the new economy, it is still going to be very positive. Remember, we all used to think in the late 1990s when the dot-com boom took place, that was going to be sufficient to throw a lot of people out of jobs, but that wasn't the case. We wanted people who had those skills to be hired and to do the job. So I think similarly, the characteristics of the jobs, the kinds of jobs are going to change, but this is not going to be mass unemployment coming as a result of that. Let me go on to one other point which you didn't ask, but which may be relevant here. Some people think, and in fact, I was listening to Stephen Myran, the president's nominee to the Board of Governors, speak today. And his point is that AI is going to be so fantastic, productivity is going to increase so much that inflation is going to come down. Therefore, you can lower interest rates substantially from current levels. That is simply not going to be the case. If you're going to be reducing if you think you can reduce inflation there, what about the higher cost of electricity for the AI case? Who's going to pay for it? It is going to be, so you're going to see a change, a shift in where the inflation comes from. It is no longer coming from oil or natural gas, but it is going to come from electricity. Houses are still scarce, home prices are high, affordability is low. That is again frustrating a lot of workers. So that is where I think future inflation is going to come, even with AI being present very much in our lives.
Shri, I also find it interesting that somebody like Myran would make an argument like that while ignoring the fact that if indeed there's a productivity miracle around AI, it would mean that it would raise return on capital. And if the return on capital goes up, that means equilibrium interest rate goes up. It's a good thing, except from a fiscal perspective. There are no free lunches. Higher productivity, higher rate of return on capital means higher interest rate, not lower interest rate. So we'll see how that basic Econ 101 maxim can be defied under the Myran hypothesis.
Exactly.
Yeah. Shri, I want to talk to you about a couple of asset classes, particularly with respect to credit, both public credit and private credit. Corporate bond spreads are at record narrows, and we are seeing a lot of financial market intermediation taking place in the private market, including all the AI stuff that we're talking about. A lot of debt raised in the private market, far more opaque than what a public sector or publicly available data would suggest. So comment on the debt creation that is happening on the private side. I think you and I are very much on the same page as far as the public debt. You've talked about high 6%, perhaps even 7% deficit likely, risk of long-term interest rates going up. So put aside the public side, comment on the private side for a moment.
Private side, as you said, the spreads are very, very low. The high yield market does not give you much higher return than if you go into treasuries or in the investment grade market. And I think the risk is mispriced. And the reason it is mispriced is because credit is readily available. The interest rates are very low. And contrary to what the Federal Reserve has been saying, I think the natural rate of interest, or R star as they call it, which does not stimulate the economy or bring it down. It's kind of neutral rate is not lower than where it is. I think it should be much higher than where they are. In other words, with the fiscal deficit being so high, it also has taken up R star or the natural rate of interest. What that tells me is that you are nowhere close to reaching equilibrium. And that is also causing a problem here on the high yield side. Now, if they are forced to increase interest rates in 2026, which I see as a distinct possibility, despite the president's statements, because the yield curve is going to steepen substantially, that is when you have problems on the non investment grade side, because there the spread is going to widen even more than the widening from 2 to 10 on the US Treasury side. Does that make sense?
Yeah, absolutely. And what about the stuff that we can't even tell from the corporate spreads, the private debt stuff? I am especially, you live in California, Sri, huge amount of money raised in California, both in the northern and southern part of the state, to finance all sorts of, venture capital into AI space. And it's not just a California phenomenon. I've talked to Silicon Valley investors. They say that, whether it is from the Middle East or Japan or Europe, investors are lining up, very much like the 2005s when people couldn't get enough of subprime investment products. Nobody can get enough of AI-related investments, and a lot of it is now financed in the private space. I personally don't have a very good handle simply because I can't find a lot of data. What's your sense, Sri?
My sense of it is, yes, there is a lot of credit that is in fact available. And you make a good comparison with 2005. If you recall, Raghuram Rajan, who again, you were in the IMF, International Monetary Fund as well, and he was then the chief economist, and he says there is a crisis brewing. He was just a bit too early. He said that in 2005, it was 3 more years before it happened. Larry Summers called him a financial Luddite for having mentioned that. He didn't see any crisis take place. So very well-educated, well-meaning people made serious mistakes in forecasting in the middle of the 2000s, in that middle of the decade. I am worried that we are reaching a similar stage now. 2008 was much worse than 2000, 2001. As we know, the 2008 crisis was much greater. And I'm thinking that the 2026 crisis may be somewhere between the severity of 2000 and the severity of 2008. It's not going to be as mild as 2000 was, not as terrible as 2008, but somewhere in the middle. And so that is my worry. October of 2007, by the way, I wrote a report saying that we are at the verge of a recession. And I was called a fearmonger. And the reason was the S&P 500 in October 2007 had reached an all-time record. When the stock market has hit a record, how can you look for a crisis? Well, that's what happens at the top of a mountain. And you then go down the precipice afterwards if the mountain doesn't continue at that same level. So even though you have a lot of promising signs, you have so many risk-related factors that are showing up that 2026 worries me. And that in turn extends into high yield credit, and it extends also particularly into the private debt space.
Just in the last couple of weeks, some of the big deals that are taking place in the US, in the media space, in the tech space, and these numbers are so exceptionally large, 30 billion, 60 billion, 100 billion. And it seems like there's never any shortage of interest from investors or financial firms who can raise this money. So to your point that the magnitude of this is, of course, unprecedented, but maybe not as bad as '08, simply because the banks are not at the core of vulnerability. And typically, a global financial crisis has to be centered around banks, and the propagation of shock then becomes very, very severe. Sri,
you made a very good point, by the way. I'm sorry to interrupt. Let's not forget it. You made an excellent point about the amount of investments that are going into AI. And I think a good part of that investment is going to be non-productive. meaning it is not going to have a good rate of return, but the cash has gone into those investments, and you're going to see a whole lot of failures in AI. Just as in 2000, when you said, in 1999 rather, if you said anything, you start a .com company, I'm ready to give you money because your company has a .com after it. And many of those companies did not survive. That doesn't mean .com is bad. It just means all of them are not going to survive. We are reaching a similar situation today. Money is being poured into anything dealing with AI. And as you mentioned, money flows from all over the world into Silicon Valley. And a whole number of investors are going to be frustrated.
Absolutely. So I want to just go back to that point that you made, because that's a pretty substantive one, that if indeed we see a big sell-off in 26, the fallout will be more severe than the .com, but not as severe as the '08 global financial crisis. So let's first talk about why it'll be more severe. I think you've already alluded to that, the magnitude of investment and so on. So I would rather actually focus on the second part, which is that it will not be as severe as '08. Is it because, as I was saying at the very end, because the banks are not at the center of this?
Banks are not at the center of this. That is one reason why it may not be as severe as 2008. The second was there were lots of errors in policy making during 2008. Ben Bernanke, who was the chairman of the Federal Reserve, in July of 2007, he was testifying before US Congress. And he said this subprime issue is just a $50 to $100 billion issue. It's not a big deal. So they did not have a good enough view of how severe it could be. Having gone through that, I think we have a better appreciation for risk. And that's one reason why I think we would not have as much of a result or as much of an impact as we had in 2008. On the other hand, though, there's something else that worries me. 2008, the fiscal deficit was not that large. The debt was much smaller, and it was possible to rescue a lot of firms. Without naming names, some of the largest investment banks in the United States should have gone bankrupt in 2008. But for the generosity of the US Treasury and Tim Geithner as Treasury Secretary, who came out to help them, many more companies would have gone bankrupt. Today, it is much more difficult to do that because the deficit is again bursting at the seams, and you don't have the same ability to print money, increase spending, and bail those companies out.
Okay, fascinating point, Sri. In '07, '08, the phrase that was bandied around a lot was too big to fail. A couple of things were allowed to fail. The market reacted very badly, and that was it. The Fed was not going to let anything else, or the Treasury, along with the Fed, was not going to let anything else fail. Now, this will, in a way, connect us to the next asset class that I want to talk about. It seems to me that there is an asset class which, from a neutral perspective, is not too big to fail, but from Trump administration's perspective, needs to be protected, which is the crypto ecosystem. Because from the president's son onward, a lot of supporters of this administration are very long crypto. If we see volatility in the crypto space, and I would include the stablecoin space as well, because the Genius Act has now paved the way for private companies to go ahead and issue currencies backed by US Treasury. So in 2026, if we see a large-scale sell-off in the crypto space and some breaking the buck sort of situation with stablecoins, would you expect the Trump administration to step in and use this too big to fail mantra to save these institutions?
They are going to try to enter and to save the institution. I think that is almost, in my mind, it's a given that given the importance, given the prominence of crypto today, that the administration would come forth to financially support it, to bail out these institutions. But the question is, in 2008, you were able to bail out a number of different financial institutions. And that ability to be so generous with the cash is going to be limited. So if you go ahead and protect the crypto industry, you're going to not protect a few other areas which you would have otherwise given money to bail out. So what I'm saying is you might still end up having one or two large-scale bankruptcies. And just as we did not anticipate Lehman Brothers to go bankrupt, and it was too big to fail, but it did fail. You may have failures of that kind coming up in 2026.
But Sri, just going back to the policy playbook of 2008, the way bailouts were done was the following. The Fed would do quantitative easing. It would choose to buy assets across the risk spectrum, including mortgage-backed securities and agency debt and so on. And at the same time, the Treasury would provide all sorts of guarantees to the loans that financial institutions would take to keep their balance sheets stable. When we talk about a crypto company or stablecoin company, would it not cause massive amount of consternation among market participants that those sort of companies are being bailed out using the same sort of instruments that were used in 2008?
I think the markets, in the immediate reaction to that, the markets will be happy. Look at what happened in 2008. We said there were mortgage-backed securities which had sunk in value to 40 or 50 cents on the dollar, down from a full dollar. And US Treasury, the generous entity that it is, actually bought it from many of these financial institutions for a full dollar. Did anybody blink an eye? Were they upset that this was happening to the large financial institutions? They turned around and gave huge bonuses to their employees. Did anyone protest? No. That's the way the system works. So the only thing that's going to limit Timur is the fact that if you go way above board in terms of the bailout, and the bond market puts in a protest, and the yields shoot up at the 10-year, 30-year level, mortgage rates become impossible to get, and the dollar sinks, let's say from $1.16 or $1.17 to the euro, it goes to, you need $1.50 to buy a euro, for instance. If you have a weakness of the dollar with respect to the yen, with respect to the euro, with respect to the pound sterling, that is when it is going to cause consternation in the market. Other than that, people don't care which entity the government bails out.
Yeah,
I mean, it feels sobering. Almost cynical to make such a statement, but that's the way the markets function.
That is indeed. Now, all this uncertainty and the expectation of intervention across various asset classes and policy levers, it manifests somewhere. So your point is that one is it will manifest in weakening of the dollar. Would you remain as constructive on gold as you were 1 year ago?
Yes, I continue to be constructive. I'm being more conservative, though. For instance, I told another interviewer in February of 2025, earlier this year, by July, we would hit 3,700. When it was still about 2,700, I said we are going to hit 3,700 by July of 2025, this year. Actually, we hit 3,800. I was wrong by $100 from beginning of the year to July. I'm now saying we'll hit 5,000 on gold by the end of 2026. It's not going to be a straight line. We have seen it go up by a few dollars and then come back because it's profit taking. But today, for instance, it is well over 3,300. Wow, it is well over 4,300 and reaching another record. And silver has also kept pace with it. So I remain very constructive. I would probably say it slows down. It doesn't rise at the same percentage extent as we did over the past year, but it's still going to be a very good investment over the next 12 months. Why do I say that? Because I don't see any discipline in monetary policy in the United States. I don't see any discipline in the fiscal policy. And when you don't have it, it is going to be reflected in the precious metals prices.
So Sri, that takes me to the question about the quality of institutions, because a lot of times, whether you and I are looking at an asset price, we will base it on fundamentals, and those fundamentals would be based on data generated by the public sector. Now, we know that this year was marked by the head of BLS being fired by Trump because he didn't like one of the data points that the BLS released. Going into 2026, will we have to continue struggling with the quality of data out of the US, or that is an aberration and it's not going to happen again?
I think you're going to continue to have an issue with the quality of the data. But here is what has happened. Powell made that statement last Wednesday at his press conference. He doesn't buy the labor market numbers. He bluntly said, I'm contributing to cutting the interest rate today because I think the labor market job creation numbers are overestimated, in his opinion. And instead of creating 40,000 jobs per month, he thinks we are actually lost 20,000 jobs per month since April. He's making a huge distinction. How did he find out? His staff told him. And so, as a result of that, he's going to use his hunch to cut interest rates. Official data be damned. We have labor market numbers which are going to come out tomorrow, Tuesday, in the United States. He's not going to wait for it. He just went ahead and cut the interest rate. Why? You would think, even if the quality is poor, because there have been cutbacks in terms of the number of employees, I don't doubt the honesty of the government employees here. But the problem they have is there are not enough of them. They are not able to collect them. They are not able to do the surveys. And that's what causes revisions to take place. Not because of ill will or because of dishonesty. But even that's all you have on the official side. And if that is the case, rather than wait for that data, Tuesday, tomorrow, we are going to get the unemployment numbers. Thursday, we are going to get inflation numbers. And if I would have said the responsible Fed should have delayed its FOMC meeting by 10 days. Heavens won't fall if you delay by 10 days. Do you have to keep your calendar that you announced at the beginning of the year when you don't have any data? That's what they did. So I don't worry about the honesty of the data. I do worry about the quality. But I worry even more about the way in which the Fed has been acting.
Yeah, and between the two Kevins, we will get at least one Kevin leading the Fed, I think, starting the middle of next year. Sri, let's do a little round of predictions. I think you've given us quite a few prognostications already with respect to gold and with respect to inflation and the likelihood of a crisis and its relative magnitude. But let's go a little more granular. What's your sense of U.S. growth for 2026?
U.S. growth, I think, remains strong through the first quarter, but the final three quarters are really a question mark. If you do have a financial crisis of some kind, it is going to pull down. So it wouldn't make sense to give you one composite number for the year. But if you want to, let me just say plus 3% annualized for the first 3 months of the year, followed by 0 in the second, and minus two in the second half of 2026. That's again my quick guess on how the growth will transpire.
So even if there is significant QE and bailouts done by the Fed and the Treasury, growth will be on the negative side, I guess largely because investment related to AI would collapse?
Investment related to AI will collapse. That is one reason. Second, if you do QE and if you keep on cutting the federal funds rate at the short end, you're going to see the 10-year and 30-year yield rise up. So hopefully we don't have a repeat of 1980, 1981. But I do remember having been a student and my early job in the United States, we had mortgage rate of 18%. And if you have the long end go up so much in yield, any amount of QE is not going to help on the economic growth side.
And would this volatility around growth have an impact on bringing down inflation by the end of 2026?
The volatility in grow. Oh, would that bring inflation down? No, I do not say so. In fact, my forecast has been, and it's already starting to take place to some extent, is stagflation. The first stagflation in the United States in about 50 years. And why do you have stagflation? Stagflation requires two things. One, you need to have one commodity that is extremely scarce and doesn't have a substitute. So when it goes up in price, you can't move from that commodity and use other commodity in your basket. In the 1970s, it was called oil. When crude oil prices tripled or quadrupled, you did not have an alternative. There was no solar energy, there was no electrical energy to power your automobiles, for instance. Now you do. On the other hand, instead of one commodity, the composite of all commodities in the basket are going up. Unless you're going to flee from the entire basket, you have to buy something, you're going to push up prices. And the second reason for expecting is stagflation requires quite significant economic mismanagement. And we had that in the 1970s and 80s. And in fact, I pointed out in one of my reports, we now have the first Federal Reserve chairman in 50 years who does not have a formal economics education. You know who the previous one was? G. William Miller, nominated by President Jimmy Carter. He came to the Federal Reserve from the manufacturing sector. And he believed, as we have seen take place in Turkey, for instance, in recent years, that reducing interest rates will reduce inflation because it will cause growth. This chairman seems to believe in the same thing, and it's not a coincidence that he did not have an economic education. And that also means that the mismanagement and bad use of monetary and fiscal policy is going to be a reason why stagflation becomes a reality again.
Is there a chance that these sort of economic volatility in the US remains contained in the US, or would you forecast the spillover from this sort of correction spilling over and creating major downside for Europe and EM?
The United States is still very large. It is still interconnected through trade and capital flows. That what happens here will be transmitted to the rest of the world. Maybe in another 50 years, there will be China will become very large, India would become very large, Brazil would become very large, and those countries may offset what happens in the United States, but not today. Today, I think the US slowdown in growth, the US stagflation, in turn, I think will be transmitted to the rest of the world.
Shri, the reason I ask this question is that this inflation issue seems to be a very US-centric phenomenon, choice-driven, tariff, immigration, etc. Because the rest of the world, 2025 has been characterized by very stable, if not declining inflation. And hence rates have come down without the markets reacting adversely in this part of the world. So if indeed in 2026, your scenario around volatile growth, volatile policymaking, stagflationary outcome, stock market correction, all of those things were to transpire, it doesn't seem to me that there is much room or necessity in this part of the world to cut interest rates or mirror the Fed's likely unorthodox actions. So I suppose I was sort of coming from there because in '08, the whole world followed the Fed with QE and a balance sheet expansion and so on, because it really was seen as the only way to stop global depression from happening. You will recall China went with the what we call mother of all credit booms in '08, '09, and in some ways the world economy sort of owes them a debt of gratitude because they really propped up demand.
Yes, they did.
I'm not entirely sure we will see a similar reaction from the rest of the world. I suppose I'm coming from there.
You may not see a similar reaction, especially because the US has been cutting interest rates significantly before the anticipated crisis of 2026. And I think that is one reason why they may not do it. The second is memories of 2007, 2008, leading to the fact that that did not help the other countries, that they followed the United States in terms of what they did. China, as you said, increased economic growth, they cut interest rates, provided the stimulus, but that also laid the foundation for the property crisis that you see in China today. And a good chunk of that happened due to the post 2008 government spending and the support for the real estate sector in China. So I think there is more. And I do remember also in early 2009 going to Brazil, and the people in the central bank would say to me, "We are not in crisis. The United States is in crisis." But this was February of 2009. We are not in crisis because we learned from our crises in the 1980s and 90s. So our balance sheet is in much saner shape than the United States is, and that's why we are not having the same issue as before. So you are correct. I think in 2026, they will not follow the United States blindly. They are going to be very careful what they do with respect to their stimulus. And if that's the case, you may see an even further weakening of the dollar. If the other countries are more disciplined and the United States is not, and that again means that the risk to the world thereafter is an undisciplined depreciation of the dollar rather than an orderly weakness.
Right. So stagflation, weak dollar, policy volatility, and a big market correction. Sri, we're not ending 2025 on a hopeful note.
No, I'm not. It is easy to do that, but I would be if there were, sorry to use the expression, if there were blood on the street, then I would say it would be a great time to buy. And we would be off again to the races and going up again. But I think we have to go through the slimming down process first before that happens.
Well, we'll take stock of all that in December 2026. Sri, thank you very much for your time and insights. I wish you happy holidays and a happy new year.
Happy holidays and happy new year to you as well, Timur. And always a pleasure talking to you.
The pleasure is all mine. Thanks to our listeners for their time as well. This podcast was produced by Ken Delbridge at Spy Studios. Violet Lee and Daisy Sharma provided additional assistance. Kopi Time is for information only and does not constitute any investment advice. All 68 episodes of the series are available on YouTube and on all major podcast platforms, including Apple and Spotify. For our research content and webinars, you can find them all by Googling DBS Research Library. Have a great day.